In this set of videos, we're going to compare Kroger stores to Whole Foods. Both are grocery chains, so in a lot of ways they're very similar, but they're very different in other ways. Kroger is mainline regulation, run-of-the-mill grocery stores, like you see everywhere else. Whole Foods is a specialty market where they emphasize healthy food, fresh food. All right, that doesn't mean Kroger doesn't sell that. It means that Kroger sells a lot of other stuff that Whole Foods doesn't. And Kroger's also expanded into, with some of their superstores over the last few years, to offer some competition to Walmart, who is, interestingly enough, Walmart, about half of its revenue is food related. So they're turning into a grocery store that also sells other stuff. But in this video, we're actually looking at Kroger and Whole Foods. Okay, so they're similar in a lot of ways, but there's some other key differences that are going to show up in their financials. One of them is scale. Kroger has had sales in calendar year 2016 of about $116 billion. And you see the statement dates up here for Kroger. That's 2017-01, the 01 being the January. So this is as of January 31st, 2017, but it's for calendar year 2016, more or less. It's from February 2016 through January 2017. Whole Foods uses a different reporting year. Theirs is September is the end of the year for them, so the 2016-09 is for the 12 months ending at the end of September 2016. It's not that uncommon for companies to have a calendar year that is different than their reporting year. You often see it in retailers because they have the big Christmas season. It's hard to get the books all closed out by December 31st. Anyway, what we're looking at is more or less calendar year 2016, 15, 14. I'm going to relabel these so we don't get confused. Because those are the years we're really looking at for both of these firms. They don't exactly match up, but they're close enough for government work. All right, so we see a big difference in the size of the revenue, and for Kroger that means they're going to have economies of scale. When you're that big, you can go out there and buy, if you're selling Campbell's soup, you can go buy 1 million cans of soup at a time. The thing is, you get a price break the bigger the order, and Whole Foods doesn't buy as much, so they're going to be at a disadvantage when it comes to purchasing on scale. The other thing is that Whole Foods will have more fresh and less canned, relatively speaking, than Kroger. All right, so there's going to be a difference in the product mix that'll show up in the ratios as we go forward. Notice that the sales here, 115 billion versus about 16 billion. This is about 7 times larger. But profit-wise, that's about $2 billion profit and 500 million. 4 times as much profit. So I can glance at these I can glance at the financials and see that Kroger is relatively less profitable than Whole Foods, but it does make it difficult to compare the actual numbers. That's why we tend to convert the numbers into percentages of revenue. That's in vertical analysis with a common size income statement. And we tend to use ratios because they'll measure the relative size of some of these numbers with each other and with the numbers in the balance sheet. All right, looking at the balance sheet, we can also see Kroger's assets are about $36 billion versus $6 billion for our friends at Whole Foods. We also notice that there's some leaps that occur over here. Kroger was doing some acquisitions in 2015 and 16 that caused some changes, and we often see that reflected in the other non-current assets, other long-term assets. if you wanted to know specifics over that, and frankly, it's usually better to go read the business summary from the 10K before you start trying to do financial analysis. But anytime you have companies doing takeovers of other companies, it's going to distort the numbers going forward. So the numbers in 2015-16 for Kroger may not be really comparable to the 2012 numbers. But that's just a financial analysis business. If we look over here in liabilities, Kroger's liabilities have gone from about 20 billion to close to 30 billion over the last 5 years. Their assets have gone from 25 billion to 36 billion. If we're looking at Whole Foods, their assets seem to be more stable, but again, it's really hard to measure 5.3 billion up to 6.3. That's a billion change, or about roughly somewhere between 15 and 20% growth. All right, so again, hard to make comparisons between absolute numbers, but that's why we use ratio analysis. All right, and we also see that liabilities make up a greater portion of total assets than do equity. All right, with Kroger, the 36 billion of total assets is funded 30 billion liabilities and about 7 billion of equity. So a lot of difference, a lot of financial leverage for our friends at Kroger. With Whole Foods, it's about half and half, the 6 billion of assets, about half liabilities, about half equity. But we also see there's been a major shift since 2012 when they had about 1.5 billion in liabilities and close to 4 billion in total equity. So big shift in Whole Foods capital structure, adding more debt and actually removing equity. If we look up here in treasury stock, that's where the company buys back shares of stock and sticks them in a drawer so in the future, in theory, they could issue them again. Their other alternative is to rip them up and then directly reduce the shareholders' equity numbers. All right, the common stock and paid-in capital. And what we see, though, is that they're putting the shares away in treasury, which means they can be reissued again. But you see, Whole Foods was buying back a little, and then they took a big chunk here in 2014, a bigger chunk here, and they bought back $1 billion worth of their own stock in 2016, whereas Kroger bought back close to $2 billion. The thing is that Kroger had a lot more stock out there to buy back than Whole Foods did. All right, so that's a pretty big sea change in there for Whole Foods. And from this point, what we need to do is start looking at the common size balance sheet and income statement to start rendering these numbers into something that's easier to read.